Most investors think the job is simple: find great companies and hold them. The better the company, the better the investment. Warren Buffett built his first fortune doing the exact opposite. He bought mediocre companies at prices so cheap they were almost free and made more money faster than almost anyone in history. It was only later, after meeting Charlie Munger, that he shifted to buying great companies. But he never, not once, said to buy them at any price. The word he always uses is fair. Great company at a fair price. Most people skip that last part. That skip cost them everything. Here's what Buffett understood that most investors still don't. A study of 64,000 stock picks found that professional fund managers, people paid millions to do this, underperform a random coin flip 51% of the time. Not because they pick bad companies, because they pay too much for good ones. Meet Daniel. Daniel does everything right. He reads annual reports on Sunday mornings, he watches the right channels, follows the right accounts, listens to the right podcasts. When everyone was piling into meme stocks in 2021, Daniel stayed disciplined. He bought Apple, Nike, and Google. Solid companies, real businesses, no speculation. He's been sitting in the red for 3 years. Not because the companies were bad, because he paid too much to own them. Daniel made the most common mistake in investing. He confused the quality of a business with the quality of an investment. They are not the same thing. Between 2000 and 2013, Microsoft's earnings per share grew 168%. The stock went nowhere, flat for 13 years, while the business kept getting bigger. The company won. The investors who bought at the wrong price lost a decade. In 1999, Cisco was the most valuable company on earth, built the backbone of the internet, revenue growing 50% a year. Analysts called it the future, and they were right. It was $80 a share. Today, 25 years later, it trades around $50. The company survived, grew, still dominant. The investors who bought at the peak are still down. 2.5 decades later on a company that did exactly what it promised. That's not bad luck. That's what overpaying looks like when you zoom out far enough. So, what is the right price? Buffett has never given a formula, but he has given a concept. He calls it intrinsic value, the real worth of all the cash a business will generate over its lifetime, pulled back to today's dollars. Not what the market says, not what analysts say, what the business is actually worth if you could see the future. Think of it this way. Someone offers to sell you a machine that prints $10,000 a year. How much would you pay? If rates are 5%, that machine is worth $200,000 in today's money. Pay $150,000 and you got a deal. Pay $400,000 and you overpaid. Even though the machine works perfectly and never breaks down. Every stock is that machine. The price you pay determines whether time works for you or against you. Buffett calls the gap between what you pay and what it's worth the margin of safety. The wider that gap, the more wrong you can be about the future and still come out fine. In his 1999 shareholder letter, Buffett wrote that he could guarantee 50% annual returns if he were managing small sums. His edge isn't picking better companies, it's knowing the price at which any company becomes a good deal. Most investors never figure out that number exists. Here's the uncomfortable part. Apple, Microsoft, Amazon. They almost never trade at a discount. The market isn't stupid. Great businesses get priced like great businesses. To buy them right, you have to buy them when nobody wants them. 2016. Apple was growing too slowly. The iPhone supercycle was supposedly over. Everyone was bored with the stock. Buffett bought $1 billion worth, then another billion, then more. He wasn't buying Apple the product. He was buying Apple the cash machine, at a price the market was too impatient to sit with. That's the actual job. Not finding great companies, anyone can do that. Waiting for the moment the market misprices one, and buying when the story sounds bad. When Buffett started buying Apple in 2016, financial press called it a mistake. He doesn't understand tech. The iPhone is dead. He made $120 billion on that position. Same company they were all watching. They just weren't watching the price. Most people look at a stock price and have no idea if it's expensive or cheap. $200 a share, is that a lot? Depends entirely on what you're getting for it. Here's the simplest tool that changes that. Imagine buying a rental property. You wouldn't pay whatever the seller asks just because it's a nice building. You'd work out the rent, figure out your return, and only buy if the math holds. Stocks work the same way. You're buying a share of future earnings. The price to earnings ratio is that math made simple. A company earns $5 per share, trades at $100. You're paying 20 times earnings. At current profits, 20 years to earn back your entry before growth, before compounding. At 15, the math can work. At 40, 50, 60, you're not really investing. You're betting that growth will be so extraordinary it justifies a price that currently makes no sense. Sometimes that bet lands. More often, it doesn't. And when it doesn't, you can be completely right about the company and still lose money for years. At the peak of the dot-com bubble, Amazon's PE was above 600. People who bought then waited 9 years to break even as Amazon became one of the most dominant companies ever built. Right company, wrong entry, 9 years. Daniel figured this out slowly. He didn't sell Apple, Nike, or Google, he held. And over time, as earnings kept compounding, the market price eventually caught up to what the businesses were actually worth. It just took 3 extra years, because he paid the excitement price upfront. He does something different now. Before buying anything, he writes down one number, what he thinks the business is worth per share, based on earnings and a reasonable growth estimate. Then he sets an alert 20% below that. He doesn't watch the stock after that, doesn't follow the news, just waits. Most alerts never trigger. He moves on. But a few times a year, something he's been watching for months suddenly drops, not because the business broke, but because the market got scared or bored. That's when he buys. He's not smarter than the market. He just has more patience than it does. Before every investment, Buffett asks one question, not, is this a great company? Not, will it grow? Am I being compensated for the risk I'm taking at this price? That shift from is this good to is this good at this price is what separates investors who build wealth from investors who watch great companies go nowhere for years. You can't control earnings, can't control the economy, can't control what happens to the stock next month, but the entry price is already locked in before any of that uncertainty begins. It's the one decision that's fully yours. Daniel's Apple eventually worked. It just made him 40% less than it should have because he paid the excitement price instead of the value price. Same company, same future, different entry, completely different outcome. Buffett's best investment wasn't Apple or Coca-Cola. It was Geico in 1976, stock down 50%, analysts predicting bankruptcy. He bought a controlling stake for almost nothing. That position returned over $50 billion. The company didn't change, the price did. Pick one company you already believe in. Find its current PE. Look at its 10-year average. If it's trading well above that average right now, you're not late to a great investment. You're early to an expensive one. Put it on a watch list, set an alert, walk away. The company will still be there when the price makes sense. And if it's not, there are hundreds of others. The investors who beat the market long term aren't smarter. They're just willing to wait.